What's going on? Welcome to my channel. I'm the covered call guy, and my goal is to create $120,000 per year passive income portfolio using only covered call ETFs. Right now, I yield about $72,000 a year, $6,000 a month, about $1,400 a week, and about $200 per day. Legal disclaimer before we start this video: this content is for information and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. Investing and trading involves significant risks, including the possible loss of principal. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Because remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, today's video is going to be more of a uh, inward look on my own portfolio. Since 2025 is coming to an end, I want to kind of recalibrate, relook at my portfolio and my forward strategy and what I expect for the next 5 years, well, 4 years, right? 2026 2030. From 2026 to 2030, I want to look at how I want to um, give myself that blueprint, right? So this is my 2030 wealth transition. My strategic blueprint for my $700,000 portfolio, right? My recalculated target is about by then 2030, I want to have at least 2 million in capital and about $16,000 a month in income. So that is my goal. Hopefully, I would have breached my $10,000 a month within the next year or 2 years. But in 2030, this is what I'm expecting, and this is how I am going to try to achieve it. All right, this is my exclusive abstract, my paradigm shift. This is the cover call guys. Kind of my little summary of myself. My portfolio right now, going into 2026, I'm gonna say it's gonna hopefully start around 700,000, depending on the market, of course. I am going to try to invest at least $100,000 a year. Yes, you've heard that right. I am going to try to push myself to invest $100,000 a year for the next 4 years, 2026 to 2030. My objective here is the wealth transition, and what I'm saying is, and what I mean by that is, I am no longer solving an accumulation problem. I am solving a wealth transition problem. With $700,000 deployed, maximum yield is not my goal. My goal is maximum after-tax reinvestable cash flow per unit of volatility. I need to preserve the engine and minimize the drag. So going forward, I need to recalculate, recalibrate, and see if my holdings is going to help me sustain and reach my goal for 2030. All right, so income tiers, my trajectory. So I labeled this the middle class, right? If I'm earning about $4,500 to $6,000 a month, I have already bypassed it. Technically, on the papers, I have bypassed this. Right now, where I'm at is the comfortable zone. My goal is to reach the wealthy zone. So right now, I'm expecting on paper getting $6,000 a month. And then once I breach the 9K mark, I'll be entering the wealthy stage is my end goal. Right. So I am here with $700,000 in capital. Although I want to make a disclaimer, I am here, but my mindset is still here because I want to give myself $2,000 to $3,000 in buffer zone. Now, why would I want to do that? It's not financial advice, but this is probably one of the few advice that I would give and say, please take it. I think this should be kind of everybody's mindset. You want to give yourself the buffer, right? If the goal is to make enough to live in big cities like California, Hawaii, New York City, right? Your goal should always be to make enough per month to live in those cities. Yes, you may never live in those cities or never want to, but if you make, say, $5,000 a month, and then you go ahead and move somewhere else that only costs about $1,500 a month, or say $2,000, you have an extra $3,000 to play around with, right? To save up for the additional emergency fund and or reinvest. I think everybody's mindset should always fall into that philosophy, right? You should have that buffer. And right now, although I am bringing about on paper, right, a lot of things can change. The payout, I'm making just about a little over $6,000 a month. I still treat it as if I'm making only $4,000 a month. So until I reach 8 to 9, then I have completely pushed out of this bracket. But yes, on papers I have crossed this, and I'm in the middle right now. And my 2030 goal is to reach here with $2 million in capital, bringing me about $12,000 to $25,000 per month. And I'll be giving a reason for these ranges, why it's such a huge range for these three brackets. My strategic regime shift with $700,000 starting capital. Well, it's not really a starting capital, but it's just what I have right now. Right, my math changes. Right, I'm moving from chasing yields to optimizing durability. Right, so my starting year, right, my old assumption, I was gonna put 200,000, but I need to be realistic here. Is I have 700,000, so I didn't really want to put a illustrative purposes. I just wanted to put what I have now, right? 2025, I'm starting with 700,000. Going into 2026, I need to start my acceleration phase. My primary risk is NAV erosion and tax drag. My optimum yield is 9.5 to 10.5, right? That is my durable. I'm a little over it right now because I am building out my MAGY position. However, once I start building out other positions to bring it back down, I will try and reach that percentage. And of course, my variable is MAGY and BTCI, right? It is my own assumption that I had it as a core or core satellite. Going forward, it would most likely play as a satellite only, as my weekly payer, as my turbo, so I can bring back the yields down. All right, my instrument stack, right, reweighted. So I will be adding SPY-I and QQI again, right? So from 2026 to 2030, these two positions will be built back up, right? That's my phase one engine, right? To bring back the 1256 tax alpha, high return on capital, and captures growth. Of course, I already have these two, right? My phase two stabilizers, dynamic override, dampens volatility. And then QDevo, my tactical alpha, right? Active singles call stocks, best in IRA. However, I have it in my taxable. And these two, of course, are going to be my satellites. They're going to get pushed to my satellites. MAGY and BTCI, right? These are my income injectors. I'm going to cap this at 10% exposure. That's how I'm going to bring the yield back down. All right, this is my architecture, right? The less fragile mix. I'm probably going to have this as my setup, with QQI being 30% of my portfolio as a growth engine. SPY-I as 25% as my core ballast. GPIX and Q, 20% as my NAV defense. QDevo as 15% as my tactical and growth. And then my satellites, my two satellites would be around 10%. So it would give me a blended yield of 10.5% with an expected NAV growth of about 3.5%. All right. Oh, I went back. My phase one, my acceleration, 2026 to 2027. My inputs here, I'm gonna start the year 2026 with 700,000, and I'm gonna try to add $100,000 per year, reinvesting 100%. I'm not gonna be spending anything. Right, my 2027 milestone hopefully would have reached 1.14 million. My income would try to exceed $10,000 per month. So that would be reaching my $120,000 goal by 2027. That would be my milestone. Right, as you can see here, right? Of course, these are all expected depending on the market and how it performs. Right, the year 2026 start 700,000. add plus reinvested at least 175,000 total, right? End value at 905,000. 2027, right? 905. Add plus reinvested 200,000. End value 1.14 million. So that is the math. That is if everything goes well, right? So that is what I'm aiming for. Phase 2 is my income hardening, right? 2028 to 2030. Right, my strategic shift here is I reduce QQI to 25%. I increase GPIX and SPY-I to 55%. And then I trim the satellites to maybe 5%. That is still what I'm not 100% entirely sure yet. But why? To control my secret rents as I approach the finish line. That is all. I might go off track off this a little bit. And when I say reduce, I'm not selling. All I'm doing is increasing the allocations to these two. And then when satellites, I'm not selling. All I'm doing is just not building it back up to where, obviously where I want to be, right? So like that 10% range. But I might keep it at 10%. This is all just still hypothetical right here. But if I were to do that, my year 2028, capital base 1.4 million, income gross about $13,000 a month. 2029, 1.7 million, about 14.5 a month, and in 2030, I reached my $2 million capital base, or about $16,000 a month. All right, my 2030 outcome, right? By 2030, I'm hoping to have a $2 million portfolio with an estimated annual income of $195,000. Net after tax income, anywhere from 13.5 to 14.5, right? The result, I am firmly wealthy. That would hit my target goal, right? Optionality now is preserved, and now I can kind of see where I want to head and maybe get off the option premium payouts and I don't know, maybe go a little bit more conservative. I don't know yet, but this is what I'm trying to reach. This is my expected goal right now. All right, my tax alpha, right? So for someone who lives in New York City, Hawaii, California, or any extremely high income states, right? 1256 income index options is my biggest edge if you want to live in extremely expensive cities, right? So ordinary income tax at damn near 50%. 1256 contract tax at 32% blended. And I say 50%, I think, depending on if you make well over a certain amount, but not going to be happening for me. The savings here on $100,000 income, $18,000, right? Extra cash I can keep annually, like versus Jeppy or Maggie. All right, my geographic optimizations, right? If I lived in California, right, the trap is that California taxed all gains as ordinary, right? 13%. My play, I would prioritize high return on capital funds like QDevo, BTCIT, deferred tax indefinitely. Or if I lived in like Hawaii, right, the edge, Hawaii taxes capital gains at 7.25%. My play, I would prioritize Section 1256, GPIX, SPY-I to arbitrage the rate. Right, my range of outcomes. This is expected, not expected. This is my expected scenarios here. In a bull case, high volatility plus growth, I could probably make anywhere from at least 22, right, up to upwards of $22,000 a month. In a base case, right, moderate volatility, I'll make around 16. In a bear case, low volatility or crash, I'll probably get pushed back down to $12,000 a month. So that's why you see such large ranges in my earlier slides, right? So even in a bear case, I hit the wealthy floor. So, you know, I'm trying to build around my portfolio where in a crash or very, very prolonged bear market, I still hit that 10 plus a month. All right, 2022 regime simulation, right? I want to use 2022 as the high volatility bear market crash scenario. If the market repeats a 2022 style slow grind down, spike in volatility, my portfolio behaves differently than the market, right? So NAV drawdown, I'm expected to maybe be around 12 to 18%, right? And then of course my satellites could go up as much as negative 40%. It just depends. I don't know. Maggie hasn't exactly experienced a very deep drawdown yet, but SPY-I, GPIX, GPIQ has. All right, distribution rate probably increases 20 to 30%, right? That's the buffer that I always talk about. All right, and then my satellite explodes, right, plus 40%. So it kind of negates, or it tries to. All right, reinvestment power is maximized, right? The IV spike, but the satellite positions, once I'm fully built out, I will not reinvest it. My verdict: my core holdings act as a shock absorber while distribution expand to fund cheap shares accumulations. So if a 2022 style happens again, you bet I will be going deep, okay, really hard onto my core and reinvest everything to buy back those cheap shares, because I've seen GPIX, GPIQ, SPY-I, I've seen them recover. QQI has also recovered very nicely from the April flash crash. So if it can do that, I am pretty positive that they can handle a bear market stress test. I would have no stress. All right, how I survived reinvestment convexity, right? Why would a crash help me? In a standard portfolio, a crash is just a loss. In my options income portfolio, a crash triggers two distinct mechanical advantages. Falling price plus higher distributions, which is volatility, equals accelerated share accumulation. I buy the most shares precisely when expected future returns are highest, right? Income versus NAV stability. Until 2030, I must distinguish between two types of stability. NAV stability, nice to have, preserve my psychological capital, and income stability. Critical mission here, right? I need to preserve the engine. A 15% NAV drawdown with flat or rising distribution is not a failure for me. It is an accelerated event. Like I said it on all my videos, when stuff like this happens, I buy, buy, buy. If you know what you hold, if you understand what you hold, if you hold great cover call ETFs in our stock, you buy. All right, quantifying my sequence risk just means I need to know that timing matters. A crash today helps me. A crash in 2030 hurts me. Scenario A is the early crash, right? 2026, the impact is going to be positive for me. My 100K annual ad buys cheap shares, right? High yields compound faster. The transition phase around 2028, the impact neutral. I begin shifting allocation, reducing QQI and MAGY, increasing GPIX and SPY-I. Scenario B, late crash, where I'm expected, right? 2030. The impact here, I would say this part would be probably negative. NAV damage, cuts, income just as I want to withdraw. Defense, phase 2 allocation. Right? How I govern risk, the MAGY protocol. The risk here is MAGY is my afterburner. That's how I treat it, right? Once I hit my 2030 mark, it is basically my done deal. It's set. In a crash, it can suffer severe NAV erosion, right? I'm expected at least negative 40% plus. That distribution cannot offset. It can buffer it as much as it can, but it cannot offset. I cannot simply set and forget this sleeve. I need a mechanical kill switch, right? My governance protocol, I'll probably trigger it if MAGY NAV drawdowns more than 25% or underperform SPY-I by more than 15% over 6 months. My first action, obviously, stop reinvesting dividends into MAGY. And action 2, harvest all MAGY income and deploy into SPY-I, my core. All right, the result, I use volatility from risky assets to buy safety and stable assets, okay? And pretty much that is my plan really going forward. I just want to put it out there and reiterate it, because once 2030 hits and my expected goal has been reached, it is no longer a priority. My structural risk and liquidity fees, my fear is always going to be liquidity, right? The question, do options ETF break in a crash? I'm going to say most likely no, right? SPX, NDX, the options, which is my core, the deepest, most liquid derivative market on earth, highly resilient. Weekly ETF options, my satellite. It is fragile. Spreads do widen, and execution suffers. My verdict: keep core holdings and index products, right? Which I've been doing. So I'm gonna go ahead and continue and stick with that plan. My fear, of course, I always talk about it. Expense ratios too. The questions are 0.65 to 99% fees too high. The reality, fees are irrelevant if tax alpha is greater than fee. Fee costs, right? $700 per 100,000. 1256 tax savings, 1,600 per year per 100,000 income. My verdict: if you live in New York City, California, Hawaii, right? Tax savings, pay the fee 2 times over. My stress test summary, right? Expected net drawdown, probably as high as or mid range of negative 14% versus market 25. Distribution change, I'm going to say it can go as high as plus 20%, right? Volatility premium expansion and income continuity is high. No forced selling no forced selling ever. All right, that's not what I want. I want to continually get paid forever, forever, forever. My strategy verdict, I say it's durable. My portfolio survives a 2022 style grind because it harvests the very volatility that hurts the market, converting fear into accumulation power. So right now, I give it a good standing. I do have to keep an eye on it. So that's what I will be continuing to do, of course. I will monitor it as I am still trying to accumulate and go into my acceleration phase. All right. My phase 1 action plan, right? I am rebalancing, right? So I'm trimming MAGY BTCI to don't push over 10%. Establish core 45% in SPY-I and GPIX. I will soon be automating, right? $8,333 a month transfer, mandatory expense. Or if I'm not automating, I will put that aside for that core. I'm using drip, enable immediately, do not spend income, right? So if I don't use drip because the market's been going up, I will turn it off. And I'm going to be auditing, verifying 1099s for 1256 and rock treatment. That's my architecture complete, right? So I have the capital, I have the blueprint. Now I build the engine. This is my 2026 to 2030 game plan. If you find it informative, educational, please give it a like, comment, subscribe. I love to hear your thoughts. I want a different perspective on my game plan. If you think it's stupid, let me know. I am very, very open to different views because it definitely helps me become a better investor. But as of right now, that is my game plan for the next 4 years, right? 2026 to 2030. I will try my best to be investing $100,000 a year of my own income, and then whatever else is distributed from my portfolio, so I can reach that goal faster, and hopefully I can go and push into my goal. So far that is going to be the holdings in my portfolio. Let me know what I should add. I want to add at least probably 2 more. I don't think I need a lot, but I am looking at probably 1 more from Neos. I haven't decided yet. I might be doing another one from Amplified. I haven't decided yet, but let me know. Yeah, I appreciate you guys liking, commenting, and subscribing. Please leave me a comment and let me know what you think of this build out, because I am very interested in different opinions. It makes me a better investor, and I appreciate that. I truly do. Thanks for watching. Stay tuned. Catch you guys on the next.